here we go. As we're talking right now, stock futures are down, and everyone's waiting to see what President Trump will announce on tariffs tomorrow, April 2nd. Feels like the second quarter is kicking off with a bit of a hurdle, wouldn't you agree?
Absolutely. You can sort of sense the market holding its breath. This anticipation around the tariff news is definitely setting a cautious tone as we move forward.
And it really makes you think, hasn't the market already factored this in? I mean, you hear rumblings, even reports suggesting a possible 20% universal tariff. That sounds, well, pretty significant.
Yeah.
So for you listening, you're probably watching the market wobble and wondering if this is, the full extent of the reaction.
That's exactly the core of what we're exploring today. We came across some insightful commentary from Michael Aurora Jones. He's a chief market strategist over at Yahoo Finance, who put it quite directly. He said he doesn't believe the market has fully priced in a 20% universal tariff.
What struck me was his comparison to the auto tariffs.
Right.
Even though those were anticipated, the market still seemed, well, surprised and reacted noticeably when they were actually announced.
Mm-hmm.
It makes you wonder if history might just repeat itself, but like on a much larger scale.
That's a key point. And when you really consider a 20% universal tariff, we're not just talking about specific sectors like cars or, steel.
Yeah.
Jones described it as a massive number on everything that's imported into this country.
Wow. Yeah.
That really helps visualize the sheer scope of what's being discussed, especially when you consider it within the context of broader economic planning.
It's like a ripple effect across the entire economy. And what makes it even more complex, and as Jones pointed out, really hard to game plan, is the potential for other countries to retaliate.
Exactly.
That's where things get really murky when you try to figure out the impact on company profits, the overall economy, and, well, individual businesses. It's not just about our tariffs going up.
Precisely. And for you, our listener, this means considering how globally interconnected your portfolio companies are. A 20% tariff on key inputs could, really decimate margins even if your company doesn't directly export.
Right.
And then retaliatory tariffs on U.S. goods could severely impact revenue.
Yeah.
This isn't just about headline numbers. It's about understanding the intricate web of international commerce.
Now, let's shift gears a bit. Another interesting area Jones touched on was the recent pressure we're seeing on AI stocks. I mean, these companies have been the real stars of the market for the past couple of years, driving a lot of the positive momentum.
They've certainly acted as a significant upside catalyst, as he put it.
Yeah.
Their strong performance and the perceived limitless potential of AI have fueled a lot of investor optimism.
But now with the overall market uncertainty, it may be a bit of a reassessment of just how quickly and smoothly AI will transform everything. We're seeing some of that enthusiasm ease off a bit. Jones stressed that the upcoming earnings season will be crucial for these AI businesses to really show whether their performance justifies those, high expectations.
This raises an important question about what will drive the market forward. If the AI sector, which has been such a strong engine for growth, starts to sputter or faces more skepticism, where will investors find the next big growth story?
It's definitely something to keep an eye on. Now, there was also a curious point about Treasury Secretary Scott Bent suggesting some potential sweeteners to soften the blow of these tariffs. Things like a tax refund for car purchases or no tax on tips. What was your take on that?
Well, while those might sound good on the surface, if we look at how they would actually work, as Jones highlighted, the government first has to collect those tariff revenues before any of these sweeteners can be implemented.
Ah, okay.
So the idea of an immediate boost to consumer spending is a bit questionable.
Right. It's not like these tax breaks magically appear out of thin air. The government first collects that extra 20% at the border on imported goods, which likely gets passed on to you at the store.
Correct.
Only after that happens might some of these tax breaks kick in, so the initial impact is still higher costs.
Exactly. And if we connect this back to the ideal scenario Jones outlined, it's not about offsetting tariffs with other financial mechanisms. The real win, the ideal scenario, would be countries deciding to lower their own tariffs, leading to genuinely open trade and, well, healthy economic growth. The current back and forth of imposing tariffs and then trying to compensate for them is just creating friction and uncertainty, not fostering growth.
It's like trying to bail out a leaky boat with a smaller bucket while the hole is still there.
Yeah.
Now, for many of you listening, your investment portfolios probably have a significant chunk in those mega-cap tech stocks.
Sure.
Jones also touched on this, saying that a market recovery will likely be difficult to achieve without a recovery in the mega-tech names. Which makes sense, right? Given how much weight they carry in the major market indexes.
It does. Their performance has a disproportionate influence on overall market sentiment and the direction of the major indexes. So, any significant and sustained weakness in these giants would likely put considerable downward pressure on the entire market.
And he even mentioned the possibility of multiple compression in the Magnificent Seven group. For those of you who might not be familiar with that term, multiple compression essentially means that investors might be willing to pay less for the same amount of future earnings.
Right.
Think of it like the price to earnings ratio shrinking.
Right.
This often happens when future growth prospects become less certain, which, is what we might see with these big tech companies given the increased competition.
What's fascinating here is the reasoning behind this potential compression. Jones pointed to the increasing competition within the AI sector. We're seeing examples like ChatGPT really challenging Google's dominance in search,
Yeah, that's huge.
and companies like Broadcom, Marvell, and even Amazon increasingly competing with NVIDIA in the crucial area of AI chips.
So all of a sudden, the future doesn't look quite as guaranteed for these companies that have been market leaders for so long. There's a lot more uncertainty about who the ultimate winners will be in this rapidly evolving technological landscape.
Precisely. The level of certainty that propelled their high valuations over the past couple of years seems to be diminishing as the competitive pressures intensify. Investors are likely going to demand more concrete proof of continued dominance and strong growth before they're willing to maintain those very high valuations.
This paints a somewhat cautious picture overall, but then you see these really unusual things happening in the market. Jones brought up the example of Newsmax, which saw its stock price skyrocket after going public,
Right.
while other IPOs, like Coherent, haven't done nearly as well. What do we make of that kind of meme stock appetite in the face of all these more serious economic concerns?
That's a really insightful point. The fact that a stock like Newsmax can experience such a dramatic surge, seemingly disconnected from fundamental business performance, suggests, as Jones put it, that there might still be excess liquidity in the tape. There's still a segment of the market engaging in highly speculative trading.
It almost feels like there are two separate things happening at once. Serious concerns about tariffs and the economy, but also this lingering appetite for speculative, high-risk bets.
Exactly. And this disconnect raises a really important question for you to consider. If there's still this significant appetite for highly speculative assets, does it indicate that the broader risks, the tariffs, the potential cooling of the AI boom, the overall economic outlook, haven't been fully priced in by the wider market?
Hmm.
Could this enthusiasm in certain corners be a sign that some investors are still underestimating the potential for a significant downturn?
It's definitely something to think about. And ultimately, Jones's concluding thought really summed up the overall feeling. He simply said, there's still a fair bit of risk out there. And after digging into all these different factors, it's hard to disagree with that assessment.
That's the core message we want you to take away from this deep dive. We've explored the significant unknowns surrounding the potential universal tariff and its widespread consequences, the shifting dynamics within the previously high-flying AI sector, and the potentially misleading signals we're seeing from pockets of meme stock activity.
Yeah.
All of these elements suggest that the market may not yet have fully accounted for the potential downside risks that lie ahead.
So as we wrap up this deep dive, it leaves you, our listener, with a crucial question to mull over. Given these significant uncertainties, the unknown scope and impact of potential tariffs, the evolving landscape of the AI sector, and the mixed signals from speculative trading, what overlooked factors might ultimately determine the true economic impact of these unfolding events? Think about how interconnected global trade really is, the relentless and often unpredictable pace of technological innovation, and the, sometimes irrational nature of investor sentiment. It feels like we're in a moment where some potentially significant shifts could be on the horizon, and understanding these underlying forces will be more critical than ever.